It's a weird market when a company literally can't build spare parts fast enough to keep up with demand, bumps their cash forecast by an absolute mile, and Wall Street still punishes them.
That's Aerospace for you right now. Perfect is just the baseline.
Honestly, yeah. Welcome to Earnings Unscripted, where we try to figure out what perfect actually looks like. Today's Thursday, July 16th, 2026, and we're looking at GE Aerospace's second quarter, ticker GE. And Mira, it really felt like they delivered on the headlines, didn't it?
Oh, completely. The core business is humming. Adjusted earnings were up nicely, and they posted 24% year-over-year adjusted revenue growth. Plus, that free cash flow generation was huge, roughly $3 billion just in this quarter alone. So naturally, the stock gapped down hard pre-market and trended lower all day.
Exactly. It rallied so hard all spring and then just took a total dive on the print, which honestly makes this a great spot to mention that you shouldn't treat our confusion over the stock dropping as financial advice. It's really just our own reading of the tape.
Right, except margins are the real story here. Even with those massive top-line beats, their adjusted operating margins contracted slightly against last year. And the spare parts backlog is still snowballing. The CFO pointed out that delinquencies, which are basically just delayed shipments, grew another 20% sequentially.
Wait, so the physical supply chain is breaking again? I thought they were fixing that with all their lean operations initiatives. I was reading about that flight deck program where they're using AI to intercept chaotic orders from suppliers. They apparently collapsed all these raw demand signals and slashed processing times drastically on turbine parts.
Yeah, they're definitely getting creative. Using an AI layer as a middleman to calm down erratic factory signals is smart, but you can't software update a physical engine blade. They raised their full-year free cash flow guide by $650 million, but that's entirely on the back of aggressively collecting receivables and cutting inventory fat, not magically curing the global supply chain overnight.
Wow. Okay, so the cash machine is working beautifully, but the factory floor is still sweating. Well, speaking of sweating, I really want to talk about why they're actively shipping their most advanced new engines at a peak margin loss right now.
Because they have to. In aerospace, selling a brand new engine model is a guaranteed way to crush your near-term profitability.
Okay, wait, walk me through that. They spend years researching a next-gen product. Everyone desperately wants it. They finally ship it, and their reward is a margin hit. That feels completely backwards.
Yeah, it's the classic razor and blade business. You sell the hardware at a tight margin, sometimes even a massive loss on those early units, and then you make it all back over the next 30 years on shop visits and parts. Right now, GE's heavily shipping their early GE9X units. Those are sitting at their absolute highest manufacturing cost.
Ah, got it. Because they just haven't worked their way down the learning curve yet on the factory floor. So the more of those brand new engines they get out the door today, the heavier the drag on the whole quarter's profitability.
Exactly. The mix of what they're actually delivering shifted heavily toward these new install engines instead of just pumping out highly profitable spare parts. It got so noisy that the CFO actually had to reassure everyone on the call. He specifically said, "There's nothing structural that is causing us to have this issue. It is all timing."
Timing. Okay, sure, but timing's everything when your backlog is bursting. So this margin trough, it's really just the toll they have to pay today to lock in that sweet services revenue for the next 20 years?
Roughly, yeah. The CFO basically signaled 2028 is when they really expect to clear the profitability trough for the newest hardware. Up until then, it's a bit of a grind. But actually, speaking of future services, there's a massive shift coming with their core LEAP 1B engines. The CEO announced they finally certified a durability kit that's expected to double the time on wing.
Time on wing. Wait, you mean literally how long the engine stays bolted to the plane before it absolutely needs an overhaul?
Yep, which is fantastic for airline unit economics. But here's the catch. They're not doing a massive immediate recall to install these kits. The full production cutover for new engines and the aftermarket won't actually hit until early 2027.
But if you're flying a MAX jet right now and you know a durability upgrade exists, aren't you going to beg GE to pull that shop visit forward? I mean, downtime is money. Aircraft on the ground is the worst thing for an airline.
You'd think so, but GE's explicitly telling analysts
that they're modeling that out of the equation. They don't expect any sudden rush of demand for retrofits. They expect airlines to just, stick to their standard maintenance timelines.
That sounds incredibly optimistic. If my car had a flawed transmission and the dealer said they finally had a fix, but I should just keep driving until my scheduled maintenance, I'd be parked on their lot tomorrow morning.
Well, your local mechanic doesn't have a global 2-year waiting list just to secure a service bay. Airlines know GE's capacity is utterly tapped out. They'd much rather fly the less durable engine today than park a revenue-generating plane in a hangar waiting for parts that are backlogged. The CEO was bluntly clear about the bottleneck. He said, "We do not have a demand problem. We're oversubscribed a year in 2026 from an internal shop visit perspective."
Right. So the priority isn't pulling forward retrofits, it's just surviving the current volume. I noticed they're really leaning into internal efficiency to survive it too, like inaugurating that new mega maintenance base in Texas to handle the turnaround.
Yeah, MTU down in Fort Worth. They're opening it just to start catching the wave of these engines needing service. And the CFO noted their repair business is growing at a massive compound annual rate, north of 20% this year, because repairing an existing part is faster and cheaper than trying to rip a new one out of a struggling supply chain.
Makes sense. Plus, they recovered $100 million from historical tariff impacts this quarter. That's a nice one-off padding for working capital. But honestly, cash doesn't turn wrenches faster.
Exactly. The $100 million is great, but it's a financial Band-Aid on a physical bottleneck. They're staring down a mountain of engines that need servicing right now, and a mountain of new jets waiting for engines on the tarmac.
So if demand's literally overflowing their capacity and they're bottlenecked on physical parts today, how are they supposed to actually hit this significantly raised guidance going into the back half of the year?
By squeezing every ounce of efficiency they can out of the existing footprint, and management's expecting that to keep working, which is why they raised targets. Larry Culp basically planted his flag on it, saying, "Given our exceptional year-to-date performance and visibility for the remainder of the year, we are raising our full-year guidance across the board."
Okay, but saying it's one thing, delivering it while your suppliers are, constantly choking is another. What's the actual outlook look like in dollars now?
Well, they bumped the operating profit target up to, it's a range somewhere between $10.55 and $10.75 billion. And they're now looking for high teens revenue growth for the year. The math works out perfectly if they just maintain this current operational momentum.
Right. Having near total visibility into a backed up pipeline probably makes forecasting a lot easier. If the parts finally ship, the cash instantly recognizes. But thinking about the whole investor reaction today, if they just hiked all these targets and admitted they're swimming in demand, why is the stock still getting hammered just over margin timing?
Because traders have zero patience for the structural realities of building actual hardware. Wall Street wants software margins right now. Culp actually had to remind everyone on the call, quote, "We do not have a demand problem. We're oversubscribed a year in 2026 from an internal shop visit perspective. But if the market has to wait until that 2028 trough clears to see peak margins, they get antsy."
We do not have a demand problem. That's the ultimate corporate flex. It really boils down to whether are you willing to endure the factory floor chaos today for guaranteed decades of service revenue tomorrow.
That's exactly the bet. If they can untangle this delinquency issue over the next few quarters without burning out the workforce, the setup for the rest of the decade is massively profitable.
It's basically an endurance test for their supply chain and for shareholder patience. All right, we'll definitely be watching that parts backlog next quarter to see if they can actually ship their way out of it. Thanks for making sense of the aerospace physics with me, Miro.
Always a pleasure. Catch you next time.
If you prefer skipping the fluff, tapping that follow button means you won't miss our next breakdown. I should also point out that this entire show was written and voiced by AI, which is exactly how we turned dozens of pages of GE filings into a podcast on the very same day. We're always looking for fresh numbers to run, so send your ticker request over to earningsunscripted@datamadness.ca
Or find that X link right in the show notes.
See you next time.